This is the Financial Freedom Pod. I'm Bruce Whitfield with certified financial planner Warren Ingram. October, November 2023, there was a flurry of excitement as markets anticipated that interest rates would start being cut aggressively in early 2024. We saw stock markets rally toward the end of that year, 25%, certainly in the United States, less pronounced in other parts of the world. And the interest rates didn't come down by nearly what was expected everywhere because inflation proved to be quite sticky and persistent, and central bankers are a cautious bunch. So, Warren Ingram, markets stayed elevated. Rates have now started coming down. I wonder whether there's any upside left in the market, because markets tend to be what they call forward-looking. They anticipate change. Whether they anticipate it correctly or not, of course, is another question. Have we missed the boat?
No, I don't think we've missed the boat at all. You're correct that markets are forward-looking. Over very short periods of time, markets also tend to be voting machines. They tend to go with the popular view, whatever the popular view is. And when you zoom out and you look at what markets do over a 10-year period, they become weighing machines. And then the weight of gravity counts, and interest rates are a form of gravity, probably the strongest form of gravity when it comes to investments. High interest rates, bad for growth investments, especially for property and shares. Low interest rates, great for property and shares. So if we're in an environment where interest rates are likely to go lower for quite some time, it doesn't matter how much lower, and you don't need to be an economist or a statistician to figure out exactly what that's going to be. All you need to know is the opportunities will still be there, and they might be there in different segments. So, stock markets are booming because at the moment it might be tech, and next week it might be biotech or whatever it is. It doesn't matter. That doesn't mean that all the opportunities in investment markets are gone. What it means is that the voting machine has moved to the flavor of the month, and that could be whatever it is, tech, AI, whatever the story is today. But into the future, something else will become flavorful. What's really meaningful is that the entire stock market is not represented by those few opportunities. And so you need to stay invested and actually start accumulating money into the markets if you can. If you've paid off your debt and you're lucky enough to be in that position because interest rates have come down and you've got some breathing room, use that money to put into the markets and don't worry about what they do over the next year or two. You actually hope that they keep falling because it gives you great buying opportunities for the next decade.
Really important, Warren, and also to understand that the main drivers of this extraordinary growth we've seen, particularly in the S&P 500 in the United States, has been driven by fewer than 10 of those 500 shares. The other 490 potentially have the opportunity to benefit from their falling rate environment. That could really well lift the performance of those companies on the stock market to also allow them to play some catch-up, perhaps.
And what will happen is that we will see segments of markets around the world doing very well, to the complete surprise of many. So we might all think that India is the next big story because they're doing good reforms, etc. And we might be quietly surprised by the Japanese stock market booming because actually they did some stock market reforms years ago that are now working out. So just understand that you will always be surprised by what does well, might not be so surprised by what does badly, but that means the spread of investments is important. And don't be too suckered into buying the things that are doing incredibly well right now. Have a bit of exposure to those, but have a lot of exposure to a lot of different investments, and you'll be okay.
I need an action. If I was to take one action based on what we've just spoken about, my action would be to do nothing. Don't overthink it. Maybe that's the best action we can take this week.
I agree, and then just make sure that you're not too exposed to the things that are the flavor of the month, and make sure that your portfolio is correctly diversified. That's all you need to do.
Certified financial planner Warren Ingram. I'm Bruce Whitfield. This is the Financial Freedom Pod.